US stocks and rate cut expectations retreat as January inflation comes in hotter than expected. Just one rate cut is now priced for this year. And New Zealand trucks got moving last month, but a full recovery in economic activity is yet to take hold. That's coming up in our 5 Things in 5 Minutes on Thursday, February the 13th. And then in today's bonus deep dive interview, ANZ Economist Krystal Tan reviews which Asian economies are most at risk from US President Donald Trump's latest tariff proclamations.
If the US priority is on economies with which it runs large trade deficits, then Vietnam will be among the top of its list, followed by Taiwan and Korea.
But first, in 5 and 5 with ANZ, US inflation overshot estimates in January, sending rate cut expectations and US stocks down overnight. A headline CPI rate of 0.5% in the month beat the consensus forecast for 0.3%, while core inflation of 0.4% was above the 0.3% expected. At 4 a.m. Sydney Melbourne time, the yields on US Treasuries were up about 8 to 10 basis points, while the S&P 500 was down 0.6% as traders pulled back expectations for how many cuts the FOMC might make this year after it held rates in January. Here's ANZ economist Bansi Madhavani.
Whichever way you look at it, the overall data was quite punchy, and it seems like there's a broad-based strength in prices rather than just small pockets driving it. And if we think about what the outlook would be following the CPI data, look, if you see the data that we've had in the first 5-6 weeks of the year, labor market is holding up, consumer sentiment was weak, fearing elevated inflation, and now inflation itself is rising at a higher than expected pace. If you overlay this with all the uncertainty around US's trade and tariff policy, fiscal outlook, and what the impact of Department of Government efficiency would be, I think it all points to the Fed staying on hold.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up 0.25%. The Aussie dollar was down 0.4% at 62.71 US cents, while the Kiwi was down 0.5% at 56.28 US cents. Number 2. Bansi says traders quickly recalibrated their expectations for US rate cuts, even as President Donald Trump said publicly that rates should be lower.
The data coming out, markets are now pricing in the possibility of fewer rate cuts this year. In fact, markets at this point are pricing in just one rate cut, which they're pricing in for the last quarter of the year. So it's very likely that we see an extended pause from the Fed.
Number 3. New Zealand heavy traffic movements jumped 4% in January, a positive sign after a tough 2024, says ANZ New Zealand economist Sharon Zollner. Although a dip in light traffic activity means people shouldn't get too excited just yet.
So truck movements tend to be correlated with GDP in real time. It's retail trade, it's wholesale trade, it's agricultural production, it's stuff moving around, probably because it's been sold, for example. So if the traffic was strong at the end of the year, then it would imply that the GDP would be strong, for example, in that same quarter. The car traffic, on the other hand, is best thought of as an indicator of momentum in the economy. It can tell you where the economy is sort of going in the longer term, sort of up to 6 months ahead, unless you have crazy stuff going on like COVID lockdowns, of course. But at the moment, it is perhaps sending a message that the recovery is going to be a bit of a long haul, I would say.
Number 4. Sharon says a per capita view of New Zealand's economic situation takes any shine off for now.
So light traffic's flat, but given we've had population growth, if you look at it on a per capita basis, it's been going down. I think that probably the most optimistic thing you could say about that is that maybe it's flattened off in the last few months. But the heavy traffic, I'd say, is telling a more positive story. It looks a bit more like a V at this point, but we'll see what February brings.
Number 5. UK December GDP data tonight will be closely watched by edgy bond markets. Bansi is forecasting a monthly rate of 0.1%, which would see fourth quarter growth actually turn negative after a flat Q3.
There are some serious concerns in the UK economy that it's facing this combination of stagnation and high prices, and this would have severe implications for the fiscal outlook. So just at the start of the year, there were concerns about UK's ability to meet its fiscal rules following the rise in gilt yields. Now, with growth weaker than previously thought, it's likely that macroeconomic projections would be lowered in the March budget update. So the Chancellor is between a rock and a hard place, trying to boost growth on the one side and trying to meet the fiscal rules on the other.
Bansi Madhavani there. Now, in today's deep dive interview, ANZ economist Krystal Tan analyses which Asian economies and sectors could be in for a rough ride from the US president's latest tariff targets.
Yeah, so 2024 was a pretty decent year for Asian exports. I mean, most Asian economies did see export growth pick up, and it was the relatively more plugged into the technology supply chain that did better. So, economies like Malaysia, like Vietnam, like Korea, like Taiwan. But more recent high-frequency data do suggest that export growth has peaked, to the extent that tech has been a key driver of the cycle. If we look at the World Semiconductor Trade Statistics Organization, they're basically forecasting semiconductor sales growth this year to be at 11% year-on-year. That's pretty respectable, but it's also quite a bit below the 19% that was seen last year. And if we look by exports by destination, I think one interesting or notable trend is that it's really been exports to the US that have been the key driver of Asian export performance over the last year.
And so how much does Asia contribute to the trade deficit that the US has? And how much has that changed since the last time President Trump was in the White House?
Yeah, so in 2024, Asia as a whole contributed roughly 62% of the US trade deficit. Within Asia, China, of course, is the top contributor at about 25% of the US trade deficit last year. But China's share has actually fallen relative to Trump 1.0. Back then in 2017, for example, China had accounted for 47% of the US trade deficit. In contrast, if we look at Asia ex-China, that share has gone up significantly. It was 25% in 2017, and last year was 38%. Now, Vietnam in particular has seen a very sharp jump. It accounted for less than 5% of the US trade deficit in 2017, but it went up to 10% in 2024.
And so what industries do you think are most at risk then in terms of, we've seen the announcements about steel and aluminium, but what else might be in the pipeline and what industries do you see most at risk from the US tariff policy?
Yeah, so President Trump has already signed executive orders, right, raising the steel and aluminum import tariffs to 25%. So within Asia, it's going to be Taiwan, South Korea, and India that stand out as relatively more exposed, when we look at the composition of their exports to the US. Now, President Trump has also previously signaled plans to potentially impose tariffs on other sectors, including semiconductors, pharmaceuticals, cars. Now, details are still lacking at this stage, but many Asian economies are going to be very vulnerable to US tariffs on semiconductors. When it comes to pharmaceuticals, it's going to be Singapore and India that are more exposed, and for cars, it is South Korea that stands out.
And given the industries that you've just mentioned, which countries do you think are most at risk or most exposed to the tariff impositions, and why is that?
Yeah, so the impact of US import tariffs on Asian economies will ultimately boil down, right, to the scope and the magnitude of the tariff measures. So I think we can look at it from several different angles. If the US priority is on economies with which it runs large trade deficits, then Vietnam will be among the top of its list, right, followed by Taiwan and Korea. Even India, Thailand, Malaysia, Indonesia, they're all among the top 15 economies with which the US runs trade deficits. Now, another angle we can consider is reciprocal tariffs, right? This is something President Trump has also mentioned. Now, India is the one that stands out as the most exposed if the US seeks to equalize overall tariffs. After India, that would then be Thailand. So let's take India as an example. So India's tariff on imports from the US were around 9.5% in 2022. And that's much higher than the 3% tariff that US had imposed on imports from India.
Krystal Tan there, talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, February the 13th. Catch you tomorrow with a rate decision in the Philippines amid all of that trade and tariff uncertainty. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.